webinar. Today, I'm really delighted. This is the part that I like. Actually, I'm delighted to introduce Charles. I mean, I can, I'm not exaggerating. I can speak around about Charles for the next 1 hour. But I mean, Charles is a true academic. Let me put it that way. I mean, it's a kind of the balanced academic. You probably, if there's an ideal type academic, the ideal type, then Charles is the ideal type. Professor Charles Cho is our 8th distinguished speaker. We've had really high-level speakers before Charles, and Charles is our 8th distinguished speaker. Before I introduce Charles, I think I would like my colleagues. I think we have 2 of my colleagues here, not 4, not 3. 2 of my colleagues. I would like my colleagues, Professor Saeed Akbar and Professor Sabu Mola, to introduce himself before I can introduce Charles. Sabu,
please go ahead.
Sabur, just say a few words and then, yeah.
Okay, good afternoon, ladies and gentlemen, and welcome, Professor Sao. Welcome to our webinar series. It is really wonderful that you have accepted our invite to give a talk at this platform. As Collins has mentioned, that we have been doing fantastic, and we are extremely grateful to the top academics. We managed to invite really world-leading academics under this platform, and we are really benefited. And as Collins has mentioned that the main idea for this academy is to actually bring academics and professionals together. We can continue debates and discussions around sustainable finance, accounting, accountability, and governance, so that we can actually have a better blending of academic research and as well as professional practices. We have a better sustainable world. That is what we are striving for. So I'm really delighted that we have got wonderful support from our colleagues as well as academic community and the professional community as well. In this note, I like to mention that we had a wonderful, successful conference last year. And again, we managed to invite top academics and practitioners there as well. And we are going to have our 2nd annual conference this year in Istanbul on the 24th, 25th, and 26th of June this year. So with that, I'd like to thank you again, Professor Charles Sao, for accepting this invitation, as well as colleagues and audience for your wonderful support all the way. And please stay with us. Thanks a lot. Professor Saeed Akbar.
Thank you, Sabur. Welcome to all of you. Good morning, good afternoon, and good evening. We have people from different regions. I'm really grateful to Professor Charles to be here. And I think the support that we received from academics like Charles is significantly important for the success of ASFAAG. And we believe that awareness will come through the success of this organization. So once again, many thanks, Charles, for being here. And we will be looking forward to receive your support, not only now, but also in the future. Thank you. And thanks to all of you for attending.
Thank you very much, Saeed and Sabu, for the introduction. I think I have to also add that there are 2 other colleagues, Professor Jill Atkins, currently at the University of Sheffield. I think we'll be joining the University of Cardiff very soon. Quite well known, Jill, and is one of the vice presidents, and also Professor Khalid Husseini, who is also not here. Is a professor of accounting and finance at University of Portsmouth. Khalid is quite also well known as also one of the vice presidents. Now, I would like to. It's my distinguished pleasure to introduce Professor Charles Cho. And I think I want to say that Charles is also nicely accepted to be part of our conference. So it would be great to come. One of the reasons to come to the conference is to meet Charles again at our conference in Istanbul, in Turkey. Now, Charles' topic today, as you can see on the screen, is hijacking sustainability into bracket accounting in the case of ESG and the IFRS Foundation. But before Charles, let me say a few words about Charles. As I wanted to say, I said earlier on, Charles is a professor of sustainability, accounting, and the apologize, I may pronounce this wrongly, Erivan K. Hub Chair in Business and Sustainability at the Shoreditch School of Business, York University in Canada. Charles' research includes social and environmental accounting, corporate social responsibility, accounting in the public interest. Charles has published very widely. And in the top journals, Accounting, Auditing Accountability Journal, Accounting Organizations and Society, Critical Perspectives on Accounting, European Accounting Review, the Journal of Business Ethics, and many others, many others. I would say more than probably 100 articles. But not only that, Charles also serves as an editor, contributes heavily to the industry, to the academy, particularly editorship. So he's the editor-in-chief or co-editor-in-chief of the Accounting Forum, and also the one of the co-editors of the accounting section for the Journal of Business Ethics, and is on a wide range of editorial boards. Indeed, Charles is very, not only actively involved in the academic community, participating in the conferences, the European Accounting Association, and many other associations, but also particularly keen on engagement with media, and in more recent times, Charles is particularly keen on the development of impact, particularly academic impact, and so on. Not just beyond academia. Charles is widely cited, not just published widely. Some people can publish in the top journal, but also widely cited. I don't know the last time I look at Charles' citations in the Google Scholar, probably close to 8,000 citations. Really one of the top accounting academics, genuine top accounting academics. So an example is that Charles recently was selected as a top 50 academic and research support project from the Republic of Korea's Prime Minister and the Minister of Education, and was recognized as one of the top 2% most cited scholars within the discipline worldwide, and was actually 34th in the world and first in Canada in accounting. So that is an indication of the person that we have here. And I have to say, let me say, this is a kind of the test, but let me say my personal bit of knowing Charles very well. Charles is really supportive of junior colleagues, and mentoring, supporting particular junior colleagues, though particularly those from the developing and emerging economies where there are challenges. I mean, I'm also on the Accounting and Finance Association, for African Accounting and Finance Association, for example. Charles has followed us to everywhere, Senegal, in South Africa, or in Uganda, Kenya, wherever we go. And that is the mark of the speaker that we have here. So delighted to see Charles here. And so Charles, over to you. Maybe I've said too much, but apologies. Over to you and audience, you and the audience. Thank you very much.
Wow, that was some introduction, guys. There's a lot of pressure now on me. Everybody's gonna expect, I don't know, I don't know what kind of speech you expect, Barack Obama style speech, but I highly appreciate the invitation. I was, I've known Colin through the work with the Accounting Forum we do, and nice to meet you all. So yes, today I just wanted to have a discussion. I want to share some insights I've been having for the last several months in relation to sustainability, this development of the Standard Board, the IFRS Foundation that you may or may not have heard, but it's actually pretty big, for the not always the good reasons, but I'm going to talk about that as well. As mentioned, I am actually, yes, involved more in this sphere, but outside the research publication. I've for a long time, because you can see that for as early as 2008 and 9, when I was much younger faculty, I was already doing those extra stuff, service in relation to sustainability, and I was involved in external bodies such as the Integrated Reporting Council, GRLI, the Global Responsible Leadership Initiative, and then recently in the CPA accounting profession in Canada. Just to show, it's not to keep bragging or anything, it's just to say that I have a view of the academic role, as Colin said, that goes beyond the academic community, and specifically on this topic. So I just wanted to say, and this is because I am going to talk about practice quite a bit. So this presentation, there is no paper. Sorry, it's only a presentation. I kept it that way because I think once you write a paper, then it's more like, okay, it's published and then we move on. But I, give this talk a few times. So as I said, I will start some academic stuff, and then I will, kind of draw from practice. And you may have heard this before. I'm sure this title has been going around because, again, this is not the first time I give this talk, but I'm happy to do it. And sometimes it would be a bit like a passionate rant. I can get pretty excited about this. So if I start being a little bit getting excited and my voice gets a bit louder, then that's because I'm getting passionate. So bear with me. And then, of course, we'll have plenty of time for questions. So I think I should be able to do that in within 40 minutes or so, 45 minutes. Let me start with discussing what is sustainability accounting. So I'm not sure how familiar you are with some of the history of that, but about 10 years ago, Dan Patton, who is my good friend and colleague, and he's now retired, but still, he's been a really great mentor and co-author with me. And he wrote this essay explaining about waves. And I know the wave is not a good word these days with the COVID stuff. I'm not talking about Corona wave or COVID wave. This is the wave of research and sustainability that actually goes back, as many people don't realize, 50 years ago, like 60s and 70s. And this is really to show that this is nothing new in accounting. CSR and sustainability accounting have been there. Then they have not been there as prominently as it is today. And I don't think even today is that prominent. But you can see that they were already interested in looking at human resource accounting, social effect, and the CSR in the first wave. So he explains that, and there's several studies that are already there. And he goes on and looks at the second wave, which is now you add some kind of, because the first wave was more like descriptive. This is a little bit more like you have another variable, some kind of two-dimensional research when you look at the reaction of the market to such information. So CSR disclosure is out there. How do financial markets react? So even that was in the sort of in the anti-80s or so. There were some things of the use of perceptions of how the user and readers of such information perceive in terms of performance or other variables of the company. And then this is where we also start looking at, okay, the whole, like, does it pay to be green, like the financial environmental performance, and how do they relate, positive, negative, or no relation? So that's kind of in the 1980s. Then he talks about what we call a ripple. So in the wave, you also have this ripple, where the focus in the 90s, it was very much centered around environmental issues, such as environmental information, disclosure, how is it captured by market valuation, some event study, like, disaster. So then how does the market react? How do the disclosure react? Environmental liability, environmental costing. And this kind of, goes in parallel with what's happening at that time. I mean, in 1992, I'm not that young, but I'm not that old. In 1992, I was still a teenager. But it was the environmental kind of like discussion around the Rio conference. And this is where, like, all businesses are starting really look at environmental closely. And I think it's kind of where the ripple comes from. And then he goes on, and this is where the more recent things happened in the last maybe 20 years or so. After 2000, 2010, we start seeing some of the mainstream accounting research embracing CSR topics. And he explains that this is when CSR reports, standalone CSR reports or sustainability reports, start appearing about 20 years ago, right? In the early 20s, you start seeing the first ones, and they offer a lot of data analysis possibility and others. So their interest shifted there, except that we think that they kind of act like they're rediscovering these things, because when you look at how they design their study and they publish, they write the studies, it's almost like a new thing. But we have shown that this is nothing new. And one of the worst thing is that you can see this has become like a hot topic in the last 10 years. It's like Accounting Review published this kind of research, CSR reporting. They have even special forum of CSR, special issue in this journal called Auditing, Journal of Practice and Theory, Journal of Accounting Economics. We, Harvard Business School, had a conference. More recently, during COVID here, Review of Accounting Studies has this theme on ESG and CSR. And then another conference, CARE, Center for Accounting Research and Education, China Accounting Review, Finance Review. And this is just a few, okay? This is like, still today you can find so many accounting conferences with the main theme of CSR or what they call ESG. But the problem that we had is that, okay, first, these topics have been examined in different, as different variable perspective, like reporting, geographic employee disclosure, data corruption, shareholder activism, investments. But the problem here, you can see here that they are basically taking CSR as a variable only and correlating with something that is already documented, such as earnings management, insider trading, signaling, financial performance. Like those are very much used financial accounting research variables. And they just look at what's the relation between ESG and something in those boxes and more, many more. So we feel like this has been instrumentalized to one variable. Okay, this is a new database in a quantitative setting that, okay, we have this database provider, there's plenty out there that provide some kind of ratings or some kind of disclosure measures to analyze and to make in a regression with these variables, already existing variables. I sort of ranted a bit also in 2020. I wrote this piece, is like, these people honestly don't understand. They don't even, I'll show you exactly what they do, is they don't even cite or recognize the scholarship that's been done before. And so I just say, well, you need to stay out of the game or step out to the plate, stay in your lane, basically, because that's a problem, right? Academically speaking. So here's the thing, what's happening. So they look at sustainable reporting in a very narrow view. They take it, everything at face value, no skepticism, no critical thinking, and it can really lead to misinterpretation of the reporting and its impact. It also have this very unique and exclusive view and focus on the value, how the CSR information is valuable or not, to explain financial performance and what's the investors care or not about this. And that can really hinder better accounting and disclosure, because you are only looking at one-sided effect of the CSR information, right? You're looking whether the investor. So I'm going to get back to that in a larger, in the later part of the presentation. But keep that in mind, like the perspective that is being taken to understand CSR disclosure or CSR information. So as I was saying, the problem that it has ignored was been done before. It is not a call to say you need to cite our work. I mean, I wasn't even existing academically or even period, but ignoring a body of research that is there, it's a poor scholarship, period. And so dismissing this kind of research is like you're selling old wine in new bottles, as Dan says, right? So it's really nothing new. They just package it differently and in different journals, and now all of a sudden it's a hot potato topic. But one of the worst thing is that they have actually know about it, because we know that Moser and Martin in the Accounting Review say that yes, there are other studies published in the Accounting Review and other accounting journals. We just don't cite such papers because it's kind of out of scope. And they say that in the kind of footnote. That's it. So they were about to get by with this commentary in 2012, and somebody, probably a reviewer, pointed it out. But they haven't. If you look at this commentary, they haven't cited a single paper that is like prior research related to this. And so it makes it appear like it's a very new, novel area where it's not. So that's simply poor scholarship, Like, even though I don't, for example, I don't particularly enjoy pure capital market research, I cite them and say, okay, this, and even you can cite them to say disagree with them, or you don't like them, or it's poorly, but just completely ignore it. That's another level, right? So that's an issue that we have. So let me now switch to sort of the practice side. And maybe that sort of gave the practice not in the same way, but you have seen and heard that financial institutions, banks, and even accounting firm, all of a sudden are experts and so crazy about sustainability accounting and finance, sustainable finance. What is that? Okay, this is kind of a new thing. And look at this, Bank of America last year says they're going to deploy $1 trillion for sustainable finance by 2030. I still don't know exactly what that means. I mean, they give this example of solar panels. Okay, is that sustainable finance? I don't know. But I'm thinking also that this is, I'm not saying that this is this is not new. I mean, obviously it's new, but this is also some of the illusion and superficiality of what they're claiming they're doing. A very telling testimony comes from, and you know, the biggest asset manager and owner in the world, BlackRock, right? BlackRock has a sustainable finance division or impact investment division. And this person here called Tariq Fancy, and this is his real name. I know it sounds funny, but it's Tariq Fancy. He used to be the chief investment officer for the sustainability finance area of BlackRock. And I say used to be because now he left and he gave an interview, many interviews actually, even today. He's kind of sort of the non-anonymous whistleblower that he used to be at BlackRock. And he says, this is maybe a distraction that we are in, right? I'm putting here some quotes of this interview. It's just one of many. If you do a Google search on his name and BlackRock, Tariq Fancy, you're gonna find articles from all over the world, like US newspaper, but I'm sure in the UK you'll find him. But even if it's not a UK newspaper, you'll find him talk, even webinars and stuff. But here are some of the very relevant quotes that I found on his interview. So very powerful interview. He says, I quickly learned that ESG isn't as useful as investing as I'd hoped. And this place was a bizarre one to try to create social impact. So basically he's saying, you know what, we have this department called social finance or sustainable finance, but at the end of the day, they are still there to train. They're trained to chase yield and profits, to make money for the clients and for themselves, right? And here he goes on, he says, the vast majority of our work at BlackRock helped the bottom line, but showed no demonstrable positive impact on society. And then he goes on, he goes, well, given that there was next to no real social impact, then he starts talking about the narrative, the talk, these famous claims and statements, and maybe even beyond that, because actually they put him in place to do sustainable finance investment, right? And he's like, well, maybe these narratives that surround this so-called sustainable investing could be harming the world by creating a societal placebo that delayed overdue government reform. So maybe this is what's preventing governments to regulate and to get into it, because they were, the large firms are speaking a lot about this. And this is what I call, like, this is maybe an illusion, maybe false optimism. You think that, wow, mainstream finance, BlackRock has gone into sustainability, and you realize that this guy comes out and he says, no, that there was no impact there. So this is not some employee who was upset to be fired. He's the chief. He used to be the head, the C-suite, okay, who comes out and speaks like this. So I'm not saying that the other employees don't count, but you're talking about somebody who was in charge of it, right? Pretty high up there. And he decided that, this is not what he signed up for. Let me switch this focus, because this idea of illusion and optimism, and I know, you're going to say, well, Charles Shaw, he's only talking about Dan Patton here, but Dan Patton gives so many good analogies that I have to cite him and say the story not as good as him, but tell you, because this is an example of how we can be in the accounting sphere illusioned or have some kind of false optimism or hype about sustainability and sustainable reporting. So here he switches and he talks about, he gives the example of these zoos and white tigers. And why in the world would you talk about white tigers and zoos? Well, he basically gives the idea that white tigers, as much are they beautiful, you may not know this, but they are actually not a species at all. You know how white tigers are created or procreated? It's a genetic process of having incestuous mating of tigers. The only way for the gene, the allele, to generate that albinism is to have a mating of incestuous tigers. So it sounds pretty, not so pretty, but in the tiger world, that's how it works. So in a way, you are looking at this, is like a beautiful animal, maybe in danger, but it is not a species at all because it's a completely artificial one. And so zoos acquired them. Even at that time, many years ago, Siegfried and Roy in Las Vegas show they acquired them. They're majestuous, they're beautiful, but they're not, right? And then he gives the example of the zoo. So that's broader than the white tiger. And he's a very powerful quote here. It's not from Dan Patton, it's from David Quammen, who wrote this piece. He says, like many of the nature documentaries on public TV, zoos may actually undermine the continued existence of what they purport to celebrate. People watch films, they visit the zoos, and the mesmeric power of these vicarious experiences, they come carelessly to believe that the Bengal tiger, the white rhino, the giant panda, or diademid sifaka is alive and well because they have seen it. Well, I'm sorry, but they haven't seen it. They've seen images. Zoos are not fragments of the world of nature. No, they are substitutes. This is part of the discussion that he was having of the pros and cons of zoos, giving the nature to the city-bound people who can now make to the wilderness, to the safaris, the jungles, and so it brings the nature to the city. But on the other hand, people will be usually tended to believe that we have seen all these beautiful animals in a zoo, so everything must be okay. And then come and counter, he's also pros and says the con is that they have really not seen the real thing. They have seen images, you know, meaning that we have captured these animals and put them on display for a show, right? That's how zoos are, right? So that's the comparison to sustainable reporting, is that similarly, okay, that people who see white tigers and the zoo and think that everything is okay because they kind of saw it, you know, in quote unquote, think that everything is okay in the world, that they will also similarly look at the whole buzz and growth of ESG and sustainability, everybody's doing it, and that assume that, oh, because we talk about it so much, we must be going to the right direction and everything is becoming more sustainable, more accountable, or both. And in fact, it's the quite opposite, because we are still a very long way to have such disclosure to address those real social, environmental, planetary accountability and sustainability issues from the organizations. So that was in a very crude and poorly imitated talk of them, because that was a keynote of the CISA conference about 10 years ago, and that he wrote a piece about it. That's the analogy to, you know, of the illusion and hype that I want to give. I think that kind of fit it there. And then I switched to sort of the narrative that Terry Clancy was talking about, the words, the language, the rhetorics. So some of my work deal with that, right? I analyze, well, at least I used to analyze lots of words and text, the language, tones, what the words mean, what they don't mean. Do companies do what they say? We know that they kind of don't. And one of the telling study that I've come across is this 2007 study by Danish researcher who looked at 40,000 corporate responsibility reports issued between 2000 and 2013. So this is a very, very large sample of reports. But, you know, to their credit, because it was so large, they didn't go in-depth analysis for that purpose. They look for references, any references to anything about ecology, planetary boundaries, ecological limits. So there's a bunch of keywords that they look for to see how much they talk about the planet, society, environment. And out of this 40,000 report, 5% in any given year had made a reference to ecological limits. Okay, this is not a lot at all. And then of that, we have only 31, so less than 0.3%, that disclose how they're going to address such limits, the plans, and, you know, how they're going to align the performance and product to such limits. So that's a small circle here. And so you have this is not like financial annual report. This is corporate responsibility report, but they don't talk about ecological limits. You know, that's crazy, right? I mean, to me, I couldn't believe. At least in the reports that I had analyzed, they kind of talk about it without really saying much. But here they don't even refer to it, especially the limits, the finite resources that we have. So another kind of like, okay, lots of pages, lots of text in this report, but not much about ecology. And then another word that comes out these days very often is the word materiality, right? So materiality, I'll get back to that when I talk about the IFRS Foundation, but it has been, it has resurged all of a sudden because everybody talks about materiality in relation to ESG, materiality in relation to sustainability, etc. So you can see that the word that launched 1,000 debates, right? So I just want to put that there. So have you, I mean, I'm sure some of you have, most of you have heard what this ESG thing is, right? So a comic picture here is that everybody is talking, not only talking about ESG, but everybody is becoming an expert in ESG. The fastest thing on earth, the top 4 are the cheetah, the airplane, the speed of light, and then people becoming specialists in ESG. So I know it kind of, you know, it could make you smile and it's funny, but it's kind of true that there are a lot of people who think that by attending a webinar here and there online, they just, you know, become ESG expert because, oh yeah, we're just gonna add those acronyms in my title and I'm gonna just think a little bit more about environment, social, and governance. And here I am, an ESG specialist. This is a hot thing to be and a hot thing to do these days, right? So in the education, even all over the world, Ireland and even the Financial Times, they, as you know, there is this demand, right? We want to teach students, MBA, undergrad, you name it. Every business school is trying to kind of get on the bandwagon and say, hey, we have to be like everybody else and giving education on this issue. But one of the risks that you have, okay, so if you are actually trained and you get a degree and specialize in that in your programs, I can say that you are probably very much into, you know, you can say you're trained, but sometimes there's some greenwashing, competence greenwashing, meaning that you are portraying yourself as an ESG expert, which you not really are. And I give some, you know, ESG anything, ESG manager, ESG associate, ESG auditor, ESG consultant, ESG, you name it. And you can see, I'm sure, job posting for your students and even for you. I get on the feed on LinkedIn all the time, this job posting, or you can see people who are saying, hey, I'm an ESG specialist in this. I mean, like it's just all over the place, right? And we don't know, we are not sure that they are really qualified, these people, some of them, right? So this is a hot trend, what I call like a fashion trend, the very popular thing. Then there is this group of people from the Harvard group, and actually Bob Eccles is also Oxford Harvard kind of privileged kind of person here, who writes all over the place, Harvard Business Review, Harvard, you know, just, and he, in this article here, I mean, the purpose was not even that. It was basically the difference between what purpose and sustainability is, which in a way, it's kind of, you know, a legitimate topic. I think it's worth talking about that. But he had the bad idea, they had the bad idea to put AKA, sustainability, AKA ESG. And that launched a lot of comments when he posted that on social media and LinkedIn. I'll share some of you with the comments because in a way, sustainability and ESG are not the same thing, right? So here are some pretty straightforward for direct comments, WTF, imagine that. Confusion seems to reign in you and your colleagues at Harvard Core Government, that's the journal, right? On the distinction between incrementalist ESG and normative sustainability. As the Global Reporting Initiative, the GRI co-founder Alan White says, ESG does not, by nature, carry a true sustainability gene. And it goes like, another comment is like, sustainability, aka ESG, Oxford, Harvard, you guys need to get up to speed. Sustainability and ESG are not the same thing. Is there not enough confusion already? And then finally, here is more like a very practical, illustrative example. Thanks, Robert. This is good, but ESG and sustainability are not the same thing. For instance, BAT, tobacco, Glencore, and Coca-Cola receive high ESG score from some research providers, but they certainly aren't sustainable. So you can see that this says it all. You can have a very good ESG ratings or score, but you know that these companies are not in the sustainability, they're not sustainability champions for sure, right? So how come? Well, I had took my own take in a very simplified way. I decided that I'm going to make difference between the two and look at some of the keywords and key themes and key topics that come up when we have ESG. So I came up with 6 keywords: impact, materiality, opportunities, risks, investors, integration. Like these are usually go along whenever there is a discussion and a comment on ESG. I think these come up a lot. And basically how we perceive ESG to be is basically a risk management process or risk management factor for investors. Again, remember when I told you about how the academic literature, the mainstream talks about so much about investor focus? That's it. They do ESG. They are looking for non-financial information, ESG, that would affect them as an investor or the business, so that they can manage and mitigate the risk of losing money on their portfolio. Climate risk, modern slavery risk, social issue, boycott, reputation, all of this is an outside-in perspective, meaning how do these factors, external factors, affect me, my business, my investment? And you can see here, this is the Royal Bank of Canada has kind of put in the report, explain what ESG investment types are, from like traditional to kind of like impact or even venture philanthropy, and look at these type of returns that they can have. They explain that you can have competitive return, and then here, ESG risk management, high impact solutions. And you read through this explanation of each type, and once again, this is really nothing to do with planetary, social, environmental issues. It's again about how to minimize, manage, mitigate the risk of the investor and the investment, well, so that they can get richer with their portfolio, right? So that we have a better return. As opposed to sustainability, which I don't even have to explain, I think, that no, really, like the report doesn't talk about ecology, ESG rarely or doesn't really talk about, contextualization of the threshold, broader stakeholder, but accountability, responsibility, environment, planet, biodiversity, and social issues. Those things, for example, right? How we're gonna try to address the impact of me inside out, my activity as a business, how does it impact society and environment? And that is not captured by ESG. That is what sustainability is. In fact, it should be both ways. Okay, we're going to talk about materiality. We call it double materiality, where it's one affecting the other and vice versa. Whereas ESG investor focus is the only what we call single materiality and going one way. So this is taking me now to the case of the IFRS Foundation. So as you may have seen, it's all over the place. So I'm sure that you have at least come across that this is going on. A consultation paper was issued in 2020, September 2020, asking for comments due in December 2020 to give feedback opinion about the creation of an international sustainability standard board, the ISSB. So basically, the argument is that there are too many standards out there, and we're just going to uniformize them and make them one single board, and we're going to be in charge of it. That's what the IFRS Foundation, which, by the way, they have really no history or no expertise in the sustainability sphere, suddenly comes up with this paper, because they are the authoritative body of financial reporting standard. That's what it stands for, IFRS, International Financial Reporting Standards. But for them to come up with it was a very strange move, and strange things happen, and they make it such a big deal. And they came up with it. So, they received over 570 letters from all over the place. They got strong support from the majority, because everybody was happy that, yes, we're going to have a standard set body that's going to make our life easier. But I wrote a letter on December 31st, on New Year's Eve, literally. So this is part of the letter. You just introduce yourself, and you have to say like that you know what you're talking about. So you have to introduce yourself and kind of like, hey, I know about this stuff. Then I share my concerns. There's four concerns. The first one is about their definition of what they mean by sustainability, sustainable reporting, and standard setting. And then the second one was, what do you mean by stakeholder? Also, what you mean by materiality. So I told you those are like words matter, and the way they define them, understand them, and use them is important. And the last comment is similar to the one I had with academia. They obviously have not done the due diligence to look at peer-reviewed academic research that was published for many, many years, and which is probably why this led to this kind of nonsense results. So I'm not going to read my whole letter. This is not the point. But here, similar to what I said about the Danish study about the lack of reference to ecology, that consultation paper, which is solely about sustainable reporting, has not talked about ecology, planet, and society. They're not even mentioned. They talk about risk. They talk about materiality. They talk about financial risk mitigation, investor. Okay, and again, they take a very investor ESG approach, and that's why I'm raising the concern there. Similarly, in terms of stakeholder, they obviously only focus on one stakeholder, who is a shareholder or the investor. Not much about the other stakeholders, kind of important, employees, customers, suppliers, governments, NGOs, and others, and even the environment. So this is not a very broad, open view of sustainability. Okay, again, so it's related to the definition and materiality. So materiality is one of my sort of favorite topic because people talk about it a lot. I give always the example of when I was working at KPMG, when I found I couldn't reconcile a $2 million difference on an account. I was stressing out. I was a very young auditor, and I was like, oh, I'm gonna lose my job, and it's gonna be very difficult. And the manager came, a couple of days later. He says, Charles, what you're working on? And I'm telling Steve, I'm very stressed about this. And he goes, Charles, it's immaterial. Just write it off. $2 million. Who cares? This was a company that was like hundreds of millions, maybe $1 billion. I understand what materiality was from the financial perspective at that time. Even though I came out of school, I understood what it was. When you look at these big numbers, you're a bit scared. But in the big scheme of things, $2 million is pocket change, right? It's like $2 million for somebody like Jeff Bezos is like 2 cents for us. Doesn't matter, right? So it's immaterial. But what I raise is how would you apply this for social and environmental issues? So how is going to address the issue of having 1,000 acres of like pristine habitat, or you have like 1,000 child laborers, or only 50 deaths if they represent a very small percentage of a workforce, or very small percentage of the ecosystem, of the environment? Is that immaterial? So in that case, if 50 deaths out of I don't know, 50,000 employees, that's really, really small in terms of just number, but it's 50 deaths. Okay, it's not $50, it's not $50 million, it's people. Same thing for children. You have child laborers, okay, in the supply chain or your own. Oh yeah, but it's like 1,000 only out of like, I don't know, like 1 million or 100,000 or 500,000. If we apply the same reasoning of financial materiality, these will never make it to the report, because what the materiality is like, let's focus on what matters in terms of relevance for our decision making. Okay, so in that sense, as we say, it has become a key rationalization for immoral activity. You can hide things under the carpet so easily in the name of immateriality or materiality. But I don't think that you can make the same analogy of dollars and people's life and environmental territories. You cannot do that. But yeah, they do. And then here I finish here by looking at how 50 years of research has been ignored, et cetera, et cetera. So that was my rant letter, which didn't do much, I guess, because I don't think they care. But what the IFRS Foundation did after that, they announced their strategic direction. Okay. They first said that they recognize the importance for the public interest of reporting standards that address enterprise value, which captures expected value creation for investors. You put these two words together, that just tells me that for them, the important thing for the public interest is the enterprise value and the value creation for investors. This, I don't know who wrote this sentence, but just that caught my eye. And I was like, this makes no sense. You know, you cannot address a market, a social public interest issue with a market-based solution, which is the investor focus, right? And of course, the very first thing they're gonna do is, yes, we will take an investor focus for enterprise value, okay? Exactly what 50-year research tell them not to do. This is the number one they do, right? Then it's about meeting the information needs of investors, as we mentioned. This was something that came up as a kind of prototype of reporting, and we know that this kind of narrow reporting is there. The blue box is kind of a wishful thinking, reporting on all matters. So I've just highlighted those two things, that this is what enterprise users, stakeholders are carrying, but not a comprehensive view of reporting. This is a very good visuals to compare the materiality issue I just described. The single materiality, which is material to the business, a double materiality, which is the value to society, and the different frameworks, regulations, standards that go along. So you can see where the ISSB clearly stands, along with the SASB, along with the Integrated Reporting Council, which has now merged to be the VRF and the CDSB. In terms of regulation, you have things like the United States SEC. And then kind of balance it out, thankfully, we still have the European Financial Reporting Advisory Group, IFRAG, the GRI with their GSSB, which already existed for a while, the SDGs, the Sustainable Development Goals, okay, and then you have a different type of other integrated models here that you have, many of them. I'm not going to go through all of them. And so here's a kind of the tension between the two. Now, recently, I know that this week, sort of miraculously, because of course the ICSB was eventually formed, I'll talk about that. But there has been apparently some discussion and understanding that collaboration, so I don't know what that will lead us, it's very recent. We can talk about that in Q&A because it's so recent. I don't have it in my slides and presentations, but they still have a very different DNA. You know, they don't come from the same kind of model and foundation. So let's see how that goes. But you know, this visual is quite useful to understand the differences, at least between single and double materiality. And of course, during the COP26 conference in Glasgow last November, no surprise, they announced the creation of this board. They again talk about this public interest with the investor needs. They again talk about investor focus disclosure. And they again talk about now, they justify the demand for it, but it's the demand that is really generated by financial markets, right? So they justify that we should do this because financial markets demand it. Our friend Robert Eccles also very happy. This is a screenshot back then, and of course he's very, you know, sharing his joy and good news that ISSB was established, but it's so important again to whom? To the markets. Okay, it's all justified by the market demand and the market satisfaction and investor needs, right? And here we go again. I mean, Bill Bowie, who was the one who used the WTF. I mean, this guy doesn't care. He has no filter. And he said again, WTF, Bob. He had listened to this same seminar, the hijacking, but Bill is very vocal about it too. He's a very good writer, very good speaker. And he basically says the ISSB, that first S, International Sustainability Standard Board, is not. You should call it ESGSB. This is what you guys doing. This is you providing information to investors, which is ESG. It is not sustainability, right? And so he had responded to the previous post of Bob Eccles, and then he referred to his own post that when that came up, he said, congratulations to all of these bodies here. And then he just make a joke, right? Instead of calling ISSB, I could leave with IESGSB because you are not doing the S of sustainability, right? And he again, quote again, Alan White, and he says, well, you have ignored or no intention to contextualize within thresholds. Sustainability is a contextualization, which the ISSB doesn't do. Their own perspective, their own boundaries is the market. You know, they don't really do anything beyond that. So, you know, yes, let's applaud IFRS for the advancement, that will, really make it easy because it's standardized, but it is ESG, not sustainability. That's the point, right? Don't call it sustainability. So with that, I will, probably leave it up in the air kind of, because it is such an ongoing debate, discussion of this space, this topic. Even I told you like a couple of days ago, I read that the GRI now has sort of they decided to do something together. I don't know exactly what, collaboration, but that's so recent that we can talk about it. You can ask me any questions you have, and you can also contact me, engage with me in email, and I'm pretty online presence on LinkedIn and Twitter if you want your information. So with that, I want to thank you for your attention, and I'm very happy to take any questions and discuss with you on this topic. Thank you very much.
Thank you very much, sir. Wonderful presentation, and the many of your thoughts are very close to my heart, basically, because I myself I've been teaching sustainable finance, and I think at least one of my students is here. And we have been talking a lot about the role of oil companies, for example, ExxonMobil, BP, and Shell. They have got quite high score in ESG. So does it mean that they are sustainable or not? We've been talking about in the other class because students are presenting their cases. So, for example, in the last week, they've been talking about Coca-Cola. So like the issues are very, very, wonderful issues you have raised, actually. I'm very pleased and really glad that you brought this discussion in this forum. Wonderful. Thank you very much. So the floor is open for questions. Colleagues, please feel free to ask your question directly. Thank you very much. Please unmute yourself. So I can see Isaac. Can you please ask your question?
Actually, my name is Hakim Ben Othman. Yeah.
Okay.
I'm from ESN Business School in France. Yeah.
Wonderful.
Thank you very much for your presentation. Actually, you made it very clear. You distinguish between the ESG and sustainability. And I think that the crux of the matter, as you mentioned, is that the ISSB is trying to address a social issue using a market-based solution. I completely agree with you. In one of your slides, you mentioned integrated reporting. Because personally, I worked on integrated reporting because we go beyond CSR. So integrated reporting involves at least 7 capitals and considers the whole model, business model, considering inputs and outputs. How can you position this integrated reporting compared to CSR and sustainability? Because integrated reporting is much broader than CSR.
It is. Yeah, that's a good question. I get it quite regularly. So this is another body that was kind of with us along with SASB. There was one that called the alphabet soup. You got all these different bodies. And yes, integrated reporting, I think in the beginning, what wanted to have, trying to basically put together the non-financial and the financial, or the sustainability and the financial report, annual report and CSR reports together. It has led to, some results like a mandatory in South Africa, for example. That's mandated. Yeah. I'm sure you know, because I'm not a particular expert I didn't really look in depth, but what I know, you mentioned it, the capitals, they have a different set of capitals that they provide a broad view of capitals. But at the end, it was still about value creation. And the question is value creation for whom? And I'm not sure. I'm sure that it's not as clear cut as the ISSB said, this is going to be value for investors. But I think the weights and the type of the trend was still a value creation for the investors still. Not completely, but I think the importance. So we're going to create value for everybody, but we're going to create more value for investor especially. That's how I read integrated reporting, because when I look at the development, and they have partnered with SASB, which tells a lot that they are aligned with the investor perspective. So my view is that they are a little bit more nuanced, but they are still in the spectrum of that investor focus maybe in a more milder way, because they have this sort of balancing other capitals that are outside investor arena. But I still think that they belong in that kind of same family, along with SASB and then CDSB. And again, they merged a few months ago with the SASB to create the Value Reporting Foundation. So they're very much on the value thing, but again, is value for whom and how much value for these stakeholders versus the other stakeholders. So
Yeah.
that would be my take on integral reporting and situating them. Yeah.
Yeah, as you said, integrated reporting originated in South Africa because South Africa is a very specific context.
Mm-hmm.
Yeah.
Yeah.
Because you know the history of South Africa and the social context in South Africa and the role of labor unions in South Africa. So financial reporting in South Africa is very specific. It's not only focused on investors. So they try to recognize, you know, the effort of labor and take care about, you know, the whole history of apartheid. And so that's why it's very specific to South Africa. And the King report in South Africa focused and laid emphasis on sustainable reporting compared to other countries.
Yeah. I feel like this is an initiative that started and it was kind of making its way. I think it was quite, you know, other countries were sort of adopted and companies were trying. And then this IFRS Foundation came in and just took over the whole thing. I feel like it's a very geopolitical like war out there to see who's going to be the standard setter of sustainability. And to me, it's a sad state of things where you are fighting for sort of this supremacy of who's going to be, where the issues are not being solved at all with the kind of perspective, right? It's just it's a sort of a political fight, you know. That's with alphabet soup. They sort of compete against sort of each other. Some of them decide to merge. So, you know, it's like banks and big four accounting firms. They used to be rivals and they merged to become more powerful. That's a whole game. That's how I see it in a very macro level. So IRC is one of those players, right? I mean, I'm not saying it's good or bad. I'm just saying that they are involved and they are a player and they play the game, right? So they decided to merge with SASB. That's part of his strategy, you know. But to me, all of this is so sad because instead of focusing on the real issue, they're looking at politics, you know. It's like, okay, guys, we need to solve some serious issue, grand challenges. So.
Yeah, there's a new market growing, you know. We hear about big auditing companies that are, you know, requiring or writing more and more about sustainability reporting. Yeah.
Yep.
Thank you.
Wonderful, wonderful. Thank you very much, Professor Saeed Akbar.
Hi, Charles. I think very useful presentation at the very right time, I think, for most of us. So I need to acknowledge this. And I think the issues you identified are probably very much misunderstood by many people in this context. My question is rather related to accounting and the role of IFRS in particular, because accounting is related to the distribution of wealth in society. So as such, I think disclosure about sustainability and sustainable reporting will not only be for the investor, it will be for everybody. And understanding that IFRS is adopted in 150 or more countries worldwide, do you think that having accounting standards on this in particular and the disclosure of sustainability accounting will not be useful for the worldwide adoption of this IFRS standard? Will this not be good for the world?
So you mean, yeah, okay, so that's obviously everybody likes harmonized standards with IFRS, but it could be good to have the same, but honestly, the other thing that I didn't really put a lot of emphasis on is that they already kind of exist. The GSSB from GRI, the Global Sustainability Standard Board, which is a lot more sustainably oriented than the ISSB. So, okay, so now we don't know because now they're going to try to do things together. So it has a multi-stakeholder approach. It has a more broader view of sustainability. But the problem with IFRS, the ISSB, is that, as I mentioned, they're going to adopt things that are fundamentally wrong for sustainability. Like I mentioned, the investor focus. So it's okay to have a standard board if they want to, but it's just fundamentally the foundation is wrong for sustain. You know, if every country adopts that, you're gonna see that those materiality issues that I showed you. This is what's gonna happen. So I don't think it's good at all for the environment. It may be good for the companies and investors and regulators. Okay, we're just gonna have one set of standards like IFRS same for sustainability, Okay, great, but isn't the sustainability standard supposed to address sustainability issues? And with the way that these standards are being founded upon, then this is not going to be good for the environment. So yes, it will be good for the investor because yes, we're going to have more uniform, more comparable, more consistent information. But it's not good if everybody uses that perspective and say, well, let's do it for the investors only focus, right? This is not good. So I get your point about, yes, it would be good that everybody adopts it, but everybody adopts the wrong thing, then it's even a bigger problem, right? So that's why we're trying to push back on this. And I'm hoping that these sort of joint collaboration, I don't want to call it joint venture, but memorandum of understanding with the GSSB, with the GRI, could balance things out. But I'm afraid, me personally, that it would be a bit like a, okay, you choose kind of thing. It should not be you choose. You should address planetary sustainability issues, not business sustainability or investor-focused sustainability issues. You should not do that. That's why I think it's a problem. Yes.
Yeah, thanks, Charles. Just my point is 100% what you are saying, because expertise will be needed in IFRS in particular to deal with the issues. But just I'm just looking into this from a disclosure perspective, because so 2-3 years ago, I looked into a report published by Tesco in relation to corporate social responsibility, which was well above 100 pages. But all those 100 pages were containing information about the product and services that they offer, rather than sustainability as such. So like my point is that in case there is a standard, then it will be persuading companies to report things which are required, rather than things which can only just like advertise their own products and services to the market. And yeah, having expert in International Accounting Standard Board will be significantly important. Thank you.
Thank you. Thanks a lot. Any further question? I can see a couple of points have been. Anwar, Hilary, do you like to ask anything? Because I saw you have been, yes.
Yeah. Thank you. Yeah. Thank you very much for that. Yeah. That was a great presentation, Charles. Very informative and insightful. And I love the title. I would just like to add, it hasn't just been hijacked. I think it's also been corrupted, the word sustainability itself. It obscures from the real issues. So sustainability accounting uses a very limited set of performance indicators, which can obscure the real issues, and the impact goes far beyond the present sustainability indicators that organizations currently use. A great point there. And if you ask an accountant to measure profitability, they can do that. They'll show you the standards that they use to do that. But if you ask them to measure sustainability, it's a whole different game. I just want to ask you about the point you mentioned about 50 years of research that has been ignored. Could you tell us briefly the key points or the key lessons we can learn from that, and what has been ignored that could have been very useful right now that we could apply in practice, and that we could apply to improve the social lives of our countries?
Well, yeah, that's a good question. But honestly, this is one of the points of ignoring that from the academics perspective. That's why at some point I said maybe it is fueling practice, the fact that they haven't really read and understand what this research has said. It is again about the social issue addressed by market-based solution. It is about we should not take a sustainability perspective or tackle a sustainability issue from an investor perspective only. There are a lot of research that shows that context matters. There's greenwashing going on, things like that. It's a very naive view that current research or practice does, that they think, just like we saw the white tigers in the zoo, that wow, this is getting, everybody's gonna talk about it and everything should be good. It's called like the business case for sustainability. Like we are doing things and it's good for everybody. Well, I'm sorry, it's not good for everybody, because if it was good for everybody, we would not have a planet in this situation. So somebody is losing, and i.e. the planet and society, and the business and investors are winning and destroying the planet, right? So the research shows that we should really change maybe the mindset and the business model, but they're going to the direction of let's take sustainability, let's kind of like hijack it, or if you want to say corrupt it, and kind of almost use it as a label to look like we're doing good for the planet, but we're not. And all of this, just a few words, a few sentences I said, is documented in this research. I mean, there's a lot. I've been, of course, in 50 years of research, but the basic stuff such as looking at sustainability from a planetary, broader context perspective has been ignored. So we have to, make sure that people read those things. But obviously, we have another issue: is like this research is also published in paywall journals. So another issue is how do we get there? So it's also like doing this talk and engaging with practice and telling them, the number of times I had to sort of, I wouldn't say confront, but like debate and engage with practitioners to explain that to them. Even on social media, I haven't been blocked yet, but some people could start blocking me because I'm like, you got to say it the way it is. You cannot, wishy-washy thing kind of say, yeah, no. I have evidence, I have scientific evidence that this is not working. So, and I say, we as a community has done that. So it's all a matter of how much you want to get your word out there and fight for them and say, this is not working. So I've been, I don't go every day, but I comment once in a while. Somebody posted like, there is hope with this SEC new climate requirement. I'm like, no, there isn't, unless there is a enforcement and accountability. So I just say things like that. Does it make a difference? Maybe not, but I know I get some kind of visibility, and then some people actually contact me asking more detail on thoughts. Like one of the alumni of my school works at the bank and on the social side, and she asked me what I think about this collaboration between ISSB and GRI. Okay, those things. So you have to just get out there and do that. What you're asking is a normative way of making things happen. Is you cannot just be satisfied and say, oh, I published my paper in this journal and that's it. No, because that's not going to take you very far. You have to go beyond that and engage with practice with this kind of mindset. Of course, you cannot speak the language of academia because they don't understand. You cannot write and say, hey, read this paper. They will never read it. But there's ways to engage with them, I think, that we can explore. So.
No, I completely agree with that. I think you're very brave to do that. I think a lot of us are quite scared to engage on social media because of all the trolling and all the negative comments you usually get there. But I think it's exceptional that you do that. And I think more of us should do that as well.
I encourage you to do it. There's nothing, I mean, they're not gonna kill you, so don't worry. And you have to be used. I mean, when you go to academic conferences, I can tell you that you can get harshly criticized too. So you may as well do something a bit more impactful and get criticized too.
But at least that's not in public, though. That's the only thing, John.
Yeah, but that's the thing is, if we stay in on our own bubble, then we're just gonna argue among ourselves, and it doesn't get out. So that's a bit of a shame to me. But anyway, that's a different topic.
Thanks a lot. So I have a question to ask before any other question we can get. Sal, so like as you understand that the large banks specifically are investing significantly on the fossil fuel, and they're claiming to be net zero, let's say by 2030, 50, whatever they're saying. So they're doing several things to do this net zero. I mean, in my view, it looks quite funny because you are insisting or helping like fossil fuel industry to grow. And on the other hand, you are maybe trying to offset carbon through tree plantation or many different other means. So how do you take this issue? Because I myself, I'm really, kind of upset because I see that, well, you guys are helping significantly on the fossil fuel industries through investment and banking. On the other hand, you like to achieve net zero. So, I mean, how does it really actually help planet in that way? So what is your view on that?
Yeah, well, the banking is going to be on the spotlight because first they make, I don't know, probably in the UK is similar, but in Canada it's a kind of an oligopoly. There are only like 7 major banks, kind of accounting firms and 4 accounting firms. So yeah. They beat record profits. I mean, the banks are so profitable. And one of the reasons is that this fossil fuel financing is a big business. and then they kind of sugarcoat it and say that they do sustainable finance, right? They try to counterbalance it. Those net zero statements, to me, don't believe anything about net zero when it's beyond 5 years. Because it's easy to make those long-term commitments and say target 2050, like 30 years from now. The planet may not even exist at the time. The people who made those statements, they may be dead. They probably will, you know, in 30 years, because those are not young people who made those statements, right? People who are like close to retirement or in the 50s and 60s. I'm not saying they're dead, but they may be completely retired. So there's no accountability for this statement. So I wouldn't even pay attention to what they say about net zero and say, oh yeah, so this bank is going to be net zero by 2050. Like, those things are so cheap to say. And they have the reason, one of the things that they have an advantage with is nobody will be there. Nobody will really check them 30 years later. You want targets that are 1 year, 2 years, 5 years down the road, make them accountable for why you haven't achieved them and everything else that, you know, make them responsible. And I think that the financing of the fossil fuel, I mean, unless you do the investors start divesting, so they just don't invest in those businesses. But bank, in terms of financing, this is you know, the highest lucrative business they can get. I mean, they know that oil business, they have so much money, they will always pay. They can, there's very safe loan, safe financing, and it's a huge disconnect. And people don't realize, how will bank pollute? Because you think, oh, bank is a service, just cut the papers and you just, no, you're right. Financing fossil fuel activity is the biggest polluting activity you can do. But I don't see them get away from it. That's a huge source of revenue for them. And whatever the statement that they make, to me, I don't really believe anything they say. You know, the banks are very good communicators. You know, it has like this facade. They say, okay, we are taking care of you. We're going to be zero. But then, of course, we don't know the details of the financing process or the financing activities, but we know that they are lending money to very, very big fossil fuel companies. So yeah, unfortunately, that's another disconnect between what they do in the sort of the backstage, but not really backstage, but what they do as an activity and what they do as a statement and communication, right? So.
Yeah, because of sustainability, I mean, I have been reading a lot because I in the recent years I've moved into this field. So after reading, I mean, you can see how do they really do not only greenwashing, but in terms of writing sustainability report, how do they manipulate the report? And you can see clearly, any reader can understand what is going on basically, because the way, as I've given example, for example, banks, or if you talk about oil companies, for example, they are trying to be sustainable. How come your heart and soul is in fossil fuel, right? How can you be sustainable? It doesn't make sense to anybody, basically.
Yeah, right.
Anyway, so is there any other question from audience? I can see several comments here. Let us see whether some of the comments could be addressed. So we have got a guy, he has left, he's not here basically. Collins has thanked, some comment, right? So it's excellent presentation. Right. Looks like, well, I mean, we have some questions here. Yad has written that under which pillar do you think, let me read the whole question. Under which pillar do you think sustainability can be quantitatively measured and reported more accurately beyond the ESG pillar? That means you are saying hijack. So which pillar could actually maybe more quantified in terms of sustainability rather than ESG? That's one question here.
Which pillar, under which pillar do you think? Okay. Quantitative measuring sustainability is always going to be a debate, because can you even actually measure it? But I think if you look at the past data that has been provided, a lot of emissions in the environment is probably the one that can be measured quite well, because I mean, I think you have companies have the tools to see like how much they pollute, how much they release toxic substance in the environment, in the water and the air. So, but I'm not sure the question beyond the hijack. Okay, so I think sustainability for me, there's a social, environmental, and financial. So the ESG is kind of borrowing from that. I mean, the governance and financial arguably could be put together, But if you're looking at, if you want to see the measure, there are tons of measures that are provided by ESG databases, right? In terms of, so their ratings based on what they supposedly do, but unfortunately it's also what they supposedly say. So I would say, you know, numbers, if you want some quantitative numbers, there are plenty of data on CSR reports, whether they are accurate or not, I don't know, but emissions and in social matters, you have also like, you know, charitable contribution, how much donation they give, what are the injury rates, the fatality rate, which again, if it becomes immaterial, they may not even make it to the report. And yeah, you have all kinds of measures. I don't know if I can answer that. I think all, in terms, all pillars could be kind of measured. I would say proxied, but they are more accurate proxy. Like for me, the environmental pollution data is probably the most measurable, right? You can rely on that, right? I mean, of course, when it's done by a third party or it's verified, not self-reported, but yeah, that would be it, yeah. So
I think the next question is even more interesting. He's saying, do you think the boards are voluntarily willing to shift their profit model to more social or stakeholder model unless there is a regulation or there is enforcement of regulation?
yeah, I mean, I think if they can avoid regulation and enforcement, they will do that. I don't think they will be shifting from a profit model. The board are also compensated based on the performance somehow. So unless you have like activist board members who are going to change, which has happened several months ago, it's like some votes have not have been blocked because of activist shareholders. And shareholders, that's one thing, but board members, I'm not sure. I'm not sure they will do that. But for sure, if it's without regulation, in fact, that makes them look better to say, hey, we're shifting from a profit model to social model because they know that there is a weak regulation and make them look good. So that's another kind of like a loophole we can have. But regulation without enforcement, again, to me, means nothing, right? It means absolutely nothing. You can have all the regulations you want, but it's not going to solve the issue. So.
Okay, so I have another question that comes in my mind. Last year, we had Alex Edmonds, and he has been talking about his book, Growing the Pie. You know that book, I think, quite well. So Profit and Purpose. I actually differ in some of the arguments he has because, well, I mean, I don't know how you can actually take both of the things together, because if you talk about the profit model, that is completely different phenomena than if you move to a stakeholder model. So if you said, oh, I'm gonna satisfy both, I don't know how much it is possible. Maybe theoretically it's possible. Practically, I think every single company will struggle to actually grow the pie, because it's not like it is in your hand. Theoretically, you can build a model, definitely, but practically on the reality, I don't know how much you can achieve. So I asked this question, and of course, I have got debates around this and several communications with him as well. So what is your view about his kind of perspective about grow the pie? Like,
well, you can grow the pie, but in, well, not so recent paper anymore. It's more like, you know, maybe it's like I published a paper on facade hypocrisy, right, in 2015. And so this is where we talk about stakeholder conflict demands. The stakeholder conflicts and demands are inherently conflicting. A supplier and a customer, an employee, and a shareholder, just those three have conflicting demand, because if you need to satisfy your employee to pay them more, well, maybe your profit will be lower, so your shareholder gets a bit screwed. If you want to satisfy your shareholder, then you're gonna have to cut costs somehow or make profit. So you're gonna have to try to lower your employee costs, and the customer, you're trying to satisfy them by lowering the price. You know, all of the three are already, I mean, it's relatively simple, right? You're looking at a company, they have customers that buy from you, they have employees that you pay, and they have shareholders that have to give a return to. And just those three stakeholders have conflicts. So you can grow the pie all you want, but the allocation and the choices that you have is going to be very difficult to satisfy, which makes it resort, this is the argument of the paper, to some hypocrisy, to talk sort of, you know, being hypocrite and say all good things and, you know, I'm going to take care of you kind of thing to everybody. So I'm not sure that growing the pie is a solution.
Perfectly right. Yeah.
It's really the change of the model, the business model of shareholder maximization. Maybe shareholder could get a profit, but not to the extent where you are impeding on other stakeholder needs, and you can take a lower return. Are you willing to take a lower return? If you are claiming that you care about CSR and social sustainability, you know, maybe you have to say, well, you know, we take a lower investment, lower return on investment. You know, how much is enough? Well, for capitalist models, it will say there's this called greed. There's no such thing as enough. It's never enough. You want more and more and more. You know, Jeff Bezos, he has, I don't know how many $1 billion in his bank account. It's not enough.
Yes.
You know, it's,
yes,
it's never going to be enough.
100% true.
Yeah. So
wonderful. I mean, that's fantastic. Another point I can, because people are not asking, so I'm asking you questions. Another point, for example, I have been reading also because I'm teaching this module. So I've been reading papers, some of the papers I read last week, and I've been talking about it in front of the class. So basically, at least a number of papers have been talking about sustainability and financial performance. So empirically, they showed that when companies are following sustainability, maybe they are box ticking, their financial profit is going high. It doesn't make sense to me as a layman. If I forget about my expertise, if I just simply think about it, this sustainability doesn't come without any cost. So you are investing in sustainability. How come you expect that your farms are doing better than any other farms like the control farm? They're not investing in sustainability. It doesn't make sense to me, at least. So what do you think about that?
So what's your question again?
The farms are saying that these papers, a couple of papers are saying when the farms are investing more in sustainability, they are making higher financial profits. So it doesn't make sense to me clearly, because farm A is investing in sustainability. It a lot of expenses become sustainable practices. On the other hand, farm B is not doing any sustainability. So they are saving the cost. So basically, how can you compare A and B, where one is sustainable, another is not sustainable? So how can you say that sustainability brings profits? I have no.
Well,
I have no idea.
Actually, I think if they are doing sustainability for making money, which that's what most firms do, in some way they can say that they are saving costs because they are, I don't know, simple things like they are using less expensive, or it consumes less energy, for example. So I don't know the magnitude of the cost savings, but I know that some business cases will have, you know, invest in those, change UPS, which is a delivery company by ground, they change their routing trajectory because instead of sitting idle and wasting gas, they made them all right turn only, because in North America, especially on the red light, you can make a right turn. And so they computed, they did all the math, and it's gonna save us cost. And it saved, to their credit, it actually saved, obviously, fuel cost, which saved dollars. So to their credit, the business case, sometimes it matters, except that, yes, it saves cost. It looks like you're saving on the environment, but yet with the saving cost and higher profit, what do? You develop more, you invest more, you grow more, you develop more, you are polluting more, right? So it's a whole like conundrum. But in the cost savings, there are cases, they call it if you look for business case for CSR, business case for sustainability, you're gonna see a lot of examples of how a company can save costs or do save cost by doing sustainability stuff. But for me, that's not even enough, right? It's like, okay, so what? You save cost, you may have done a little bit good for the environment, so-called, but then what are you gonna do with those save costs? You have record profit, you're gonna have to reinvest in another business, build another plant, and destroy another forest. You know, that's what they're gonna do doing. So it's a perpetuation of the growth and development, and make the investor richer and richer, right? So I would balance it out. I would say it's possible. I know it doesn't make sense because you invest more and but that long-term sort of sometimes it pays off. They do all this computation to say, yeah, it's going to save us money, and then we invest in sustainability in the long term. So
yeah, it makes sense. I mean, in some way, for example, if they focus more on R&D and specifically AI and robotics, so they can save cost. On the other hand, they are going to have job cuts. They're reducing their employees. So basically, we talk about the social aspect of it. You are reducing employment, and that may harm your sustainability as well. So like,
yeah,
it's a quite tricky balance, actually. I think which path you will take.
yeah, exactly. No, it's all about balance, and then
exactly,
how do you make the decision? Yeah.
Wonderful. Any other question from audience? Looks like people are quite exhausted. Wonderful. Thank you very much, Professor Sao, for your wonderful presentation. Very, very insightful, very lively, I would say. And then there are a lot of practicalities around. You try to bring the cases here, and I think we enjoyed a lot. And I'm sure the platform as well as the audience actually learned a lot from your presentation. And we'd like to see you again in the future in our platform, definitely. Thanks again for listening, audience, all colleagues and friends. Please stay with us. We'll have monthly webinar running as usual, as you can see. And also, I'd like to invite you to our second annual conference in Istanbul. The call should be out very, very soon. So thanks again for your wonderful attendance. And finally, Sal's wonderful presentation. Thanks a lot. Thanks a lot. Thanks a lot.
Thank you
for
very
your time.
much. Thank
Thank you
you. With
very much.
pleasure.
Stay in touch. Thanks a lot. Bye-bye.
Bye-bye. Thank you.
Bye. Thanks a lot. Bye.